Let's start with Origin Energy. Along with AGL, it's one of the most important companies in this country as an energy generator and as a retailer. Its role in the energy transition is vital, and that will come into focus once its Eraring coal-fired power station, the largest in Australia, closes in 2 years' time. Now, for 18 months, Origin has been stalked by the Canadian investor Brookfield and EIG, the American company, for a takeover. They've made no fewer than 5 takeover attempts so far. This week, shareholders were to vote on their best and final offer, $9.53 a share, worth $20 billion. Directors recommended the offer. It was accepted by the ACCC, but for that bid to succeed, more than 75% of investors had to say yes. But one shareholder, the country's biggest superannuation fund, Australian Super, said no. Not only that, but then bought more shares in Origin and lifted its stake to 17%. It was a blocking stake. It was concerned that long-term, a stock market without Origin meant fewer investments for it to share in the rewards that may come from the renewable energy transition. Now, on Thursday, the shareholder vote was deferred. Brookfield and EIG scrambled together a new and even more complicated offer. Australian Super still said no. But if Brookfield does walk away, the Origin Energy share price is likely to fall heavily. So, is Origin too important a company to disappear from our stock market, or is this just another deal? Jamie Hanna is the Deputy Head of Investments and Investment Manager Van Eck, one of Origin's biggest investors with 5.4 million shares, and joins me now. Jamie, many thanks for your time. You were in agreement with this bid, with this new revised offer that's now hit the table. Are you in agreement with that as well?
We're certainly in agreement with the existing offer that was on the table as of yesterday, and we certainly, activated our vote and said that we were voting for the underlying deal. This new deal, however, obviously the existing one is still on the table. We're still, for the existing deal. The new one, however, is completely more complicated for any shareholder, including likes of ourselves, where they're selling down in multiple tranches, with the energy business going to Brookfield and then a separate vote going over to EIG. So this structure doesn't necessarily work for many investors, and there's 120,000 mum and dad investors in energy, in the whole entire, industry. So the fact here is that we are still for the deal in its current form, but we're certainly not advocating for a change in the structure at this point.
Okay, so just explain to me that philosophy about a stock market without Origin Energy. Does it make it harder for you as an investment manager to get your share of the energy transition and the rewards that are likely to come from that?
Having one less company on the exchange is always it makes it harder as an Australian investor to express an idea. The likes of Australian Super, however, like for example, they obviously have global operations. Our funds that we manage have global operations as well. So it's taking it away, generally speaking, from retail investors, an investor who might want to get exposure to it. Institutional investors can source, these type of investments offshore. So it's really playing into that hand. That said, I hate seeing companies coming off the stock exchange, good Australian companies. We've seen Sydney Airport go. There is the chance that Origin will go here as well. The fact is yes, it's one less company for Australia, but at the same time, anyone's portfolio can be diversified in any different way, being offshore or investing within other companies within Australia. There's still AGL, there are still a number of other companies available. However, if you're the likes of Australian Super, they've got huge capital reserves which they need to deploy within the Australian market. And for them, yes, absolutely, there'll be one less company for them to invest in.
Okay, so one of the reasons why the ACCC set aside the competition objections to this takeover was the fact that Brookfield had agreed to commit $30 billion, I should say, to the energy transition, to accelerate that into the future. And this was seen to be important in the national interest, if you like. And so, therefore, what position do you think Origin is in if this deal does not go through to actually raise that money itself and to actually contribute, as Brookfield might have otherwise contributed, to that energy transition?
There's absolutely no doubt that Origin will need to increase their energy transition targets. At the moment, it's somewhere between 3.5 and 5 gigawatts. Brookfield will coming in at 14 gigawatts and fully funding that themselves. And Brookfield also having all the experience, knowledge and manpower, resources globally to achieve it. So if the deal falls apart, then there is no doubt whatsoever that Origin will have to increase their targets, source new capital to finance that. And Australian Super has indicated that they could be a source of that funding, but they will have to source it from the market. And in the short term, any form of financing is expensive with interest rates going up. That's the companies are no exception to that. So yes, it is a much better deal with Origin. For them to actually, go with Brookfield, and hence why they've been recommending it. But assuming it doesn't go ahead, then, well, they're going to have to change the targets. The board will have to set new goals, and they'll have to finance it. So all I can say from that point of view is, expect some changes happening at the company.
Okay, there's one other truism about all of this, and that is if Australian Super thinks that Origin is such a brilliant investment long term, as you point out, it's got plenty of financial depth. It could buy the company itself.
Well, it could, but it's expressing no real desire to do so. They're really just exercising their rights as a shareholder. They're exercising their rights in a valuation. They're operating well within their rights of the shareholder on behalf of millions of Australians. So from that respect, Australian Super can do whatever they want, but will they buy the whole thing and do it? No, I don't think it's within their remit to do that at this point in time. They've certainly expressed no real desire to do that. So I don't imagine that to be, the base case for them. They're really looking at it in terms of an equity investment listed on the ASX.
So just tell me about this, because the independent advisor to this bid, Grant Samuel, came in with a range of prices, a price range rather, whereby it felt it was fair value. When you came to make your own determinations of what was a fair value for Origin, was that a difficult thing to decide, given much of the upside in the energy transition is ahead of the business?
Yes, it is. And any form of valuation on a company is completely subjective, and it really relies on the inputs that go into it, as well as projections of where you think cash flows are coming from. Part of the difficulty in valuing, Origin is the fact that it looks like Australian Super are putting quite a margin onto the Octopus Energy, the British energy arm of that. And there could be some considerable upside, but it's extremely difficult to value exactly where that is. And so the independent valuations, our valuations, looking at not overdoing the Octopus side of the takeover, is saying that, well, where is fair value? Where is it trading at now? What is good for our shareholders? And we come up to a value around $9.50. So the offer on the table met our expectations, whereas Australian Super obviously putting a higher forecast on where they think those medium to long-term cash projections are going, and that's their prerogative to do so. But look, at the moment, the share price is trading nearly $1 below where the offer is.
And that's the other reality. If this offer does disappear for whatever reason, the share price of Origin, short term at least anyway, can only go one way, can't it?
Well, it's unlikely to go up to the takeover price of $9.50 in the short term, that's for sure, if the deal falls over. It's difficult to say how much it will fall, how much takeover premium is sitting within that price, but there is certainly some. So the risk will be on the downside to the share price if it falls over.
So you mentioned a little earlier Octopus Energy, the British energy business that Origin has created, which is actually showing significant growth at this stage. But that's where the complication comes in. With the new bid coming out from Brookfield and EIG, even that business gets sold in what is a bit of a roundabout, sort of a convoluted fashion. So this is, again, what makes it very difficult for investors to wrap their head around whatever this new deal is.
Absolutely. The whole new structure of the deal is difficult to understand. It's really playing into the fact that there's a 50% vote required and not a 75% vote required to get it over the line. But then it's a multiple stage project under the new restructured second offer. So look, you've got to convince the large shareholders, or you're trying to avoid Australian Super from exercising their rights. It's going to be a very difficult challenge to get over the line. in its current form, as much as we're voting for it, it doesn't look like it's going ahead. They might be able to work out which shareholders, apart from Australian Super, are voting against it and work on them over the next week or two. However, it just looks like an uphill battle to get this deal over the line in its current format or in the proposed one.
The Deputy Head of Investments at the investment manager Van Eck, Jamie Hanna, many thanks for your time on the program today.
Thank you.